Hi guys, this is Cindy Sophia Yap, and this video is about the capital structure theory. So first, what is capital structure? It is synonymous to financial leverage. In the capital structure of the company, there are mainly two types of capital, equity and debt. Capital structure deals with the question, what should be the ratio of debt and equity? Going back to the prime objective of a financial manager, it is to maximize the shareholders' wealth or increase the value of the firm. The same may be achieved if an optimal capital structure is designed for the company. Thus, the optimal capital structure is the capital structure at the level of debt to equity proportion where the market value per share is maximum and the cost of capital is minimum. There are four capital structure theories. First, the net income approach. Second, the net operating income approach. Third, the traditional approach, and fourth, the Modigliani and Miller approach, or the MM approach. For this video, we are going to focus on the MM approach. In 1958, Professors Franco Modigliani and Merton Miller proved that under a restrictive set of assumptions that a firm's value should be unaffected by its capital structure. The following are their assumptions. First, there are no brokerage costs. Second, there are no taxes. Third, there are no bankruptcy costs. Fourth, investors can borrow at the same rate as corporations. Fifth, all investors have the same information as management about the firm's future investment opportunities. And lastly, EBIT is not affected by the use of debt. The effects of taxes. Modigliani and Miller recognized that the tax code allows corporations to deduct interest payments as an expense, but dividend payments to stockholders are not deductible. This differential treatment encourages corporations to use debt in their capital structures. In other words, the debt shields some of the firm's cash flows from taxes. MM demonstrated that all of their assumptions hold. This differential treatment leads to an optimal capital structure of 100% debt. Miller noted that bonds pay interest, which is taxed as personal income at rates going up to 35%, while income from stocks comes partly from dividends and partly from gains. Further, most long-term capital gains are taxed at a maximum rate of 15%, and this tax can be deferred until the stock is held and the gain is realized. If a stock is held until the owner dies, no capital gains tax must be paid. So on balance, returns on common stocks are taxed at lower effective rates than returns on debt. Because of the tax situation, Miller argued that investors are willing to accept relatively low before-tax returns on stocks as compared to the before-tax returns on bonds. For example, an investor in the 35% tax bracket might require a 10% pre-tax return on Company A's bonds, which would result in a 10% multiplied by 1 minus t is equal to 10% multiplied by 1 minus 0.35 is equal to 10% multiplied by 0.65, and then the after-tax return is 6.5%. Company A's stock is riskier than its bonds, so the investor would require a higher after-tax return, say 8.5% on the stock. Because the stock's returns would be taxed at only 15%, a pre-tax return of 8.5% divided by 1 minus t is equal to 8.5% divided by 0.85, which would then equal to 10%. It would provide the required 8.5% after-tax return. In this example, the interest rate on the bonds would be 10%, the same as the required return on stocks. Thus, more favorable treatment of income on the stock would cause investors to accept the same before-tax returns on the stock and on the bond. The effect of potential bankruptcy. According to MM's assumptions, firms don't go bankrupt and that bankruptcy costs are irrelevant. However, bankruptcy exists and it can be quite costly. Firms in bankruptcy have high legal and accounting expenses, and they have a hard time retaining customers, suppliers, and employees. Note too that the threat of bankruptcy, not just bankruptcy per se, brings about these problems. If they become concerned about the firm's future, key employees start jumping ship, suppliers start refusing to grant credit, customers begin seeking more stable suppliers, and lenders start demanding higher interest rates and imposing stricter loan covenants. Bankruptcy-related problems are likely to increase the more debt a firm has has in its capital structure. Therefore, bankruptcy costs discourage firms from pushing their use of debt to excessive levels. Note too that bankruptcy-related costs have two components: the probability of their occurrence and the cost that will be incurred if financial distress arises. A firm whose earnings are relatively volatile, all else equal, faces a greater chance of the bankruptcy and thus should use less debt than a more stable firm. This is consistent with our earlier point that firms with high operating leverage should limit their use of financial leverage. Likewise, firms whose assets are illiquid and would have to be sold at fire sale prices should limit their use of debt financing. Trade-off theory. This theory states that firms trade off the tax benefits of debt financing against problems caused by potential bankruptcy. In this figure, it shows the effect of leverage on the value of Company A's stock. Using more debt reduces taxes and thus allow more of the firm's operating income to flow through the investors. This factor on which focus tend to raise the stock's price. Indeed, under the assumption of MM's original paper, the stock price would be maximized at 100% debt. The line labeled results in incorporating the effects of corporate taxation and expresses the relationship between stock prices and debt under their assumption. In the real world, firms have target debt ratios that call for less than 100% debt. The reason is to hold down the adverse effects of potential bankruptcy. There is some threshold level of debt labeled D1 in which the probability of bankruptcy is so low as to be immaterial. Beyond D1, however, bankruptcy-related costs become increasingly important and they begin to offset the tax benefits of debt. In the range from D1 to D2, bankruptcy-related costs do not completely offset the tax benefits of debt, so the firm's stock price continues to rise as its debt ratio increases. However, beyond D2, bankruptcy-related costs exceed the tax benefits, so from this point on, increasing the debt ratio lowers the stock price. Therefore, D2 is the optimal capital structure, the one where the stock price is maximized. Of course, D1 and D2 vary from firm to firm depending on business risk and bankruptcy cost, and they can change for a given firm over. Signaling theory. A manager may use capital structure changes to convey information about the profitability and risk of the firm. For example, employers can rely on applicants' chosen level of education or certain education credentials as a credible signal of the person's underlying competence. Assumed that everyone, investors and managers alike, has the same information about a firm's prospects. This is called symmetric information. However, in fact, managers often have better information than outside investors. This is called asymmetric information. It is based on the idea that insiders know something about the firm that outsiders do not. Information disclosed by managers to the market reduces information asymmetry, and it is interpreted as a good signal by the market. Examples are firms that voluntarily apply IFRS create a certain reputation and image which in turn signal their ambitions, which can be used as advertising to become more competitive. A high payout ratio may signal a firm as having a confident future. For an entrepreneur to go public, equity retained is a signal because it is not rational for a bad news manager to retain a high equity position. So what keeps signals reliable? The answer is cost. A signal will be reliable if it is beneficial to produce truthfully, yet prohibitively costly to produce falsely. Using debt financing to constrain managers. Firms can reduce excess cash flow in a variety of ways. One way is to funnel some of it back to shareholders through higher dividends or stock repurchases. Another alternative is to tilt the target capital structure toward more debt in the hope that higher debt service requirements will force managers to become more disciplined. If debt is not serviced as required, the firm will be forced into bankruptcy, in which case its managers would lose their jobs. Therefore, a manager is less likely to buy an expensive corporate jet if the firm has large debt service requirements. A leveraged buyout is a good way to reduce excess cash flow. In an LBO, debt is used to finance the purchase of a high percentage of the company's shares. Of course, increasing debt and reducing free cash flows has its downside. It increases the risk of bankruptcy. So to complete the analogy, the capital structure decisions comes down to deciding how big a dagger stockholders should use to keep managers in line. And that's it for the capital structure theory. Bye guys!